Silver just punched through $92. Not slowly, not gradually, it exploded. 4.7% in a single trading session. Silver ripped $4.12 higher in one day, and the candle on the chart looks absolutely violent. This is the kind of move that makes traders stop what they're doing and stare at their screens. But here's what most people watching silver today don't understand. The price move is not the story. The price move is the symptom. What's happening underneath the surface, in the vaults, in the delivery rooms, in the back offices of the biggest banks on the planet, that's the story. And I'm going to tell you exactly what that story is tonight, because the data I pulled together over the last 4 hours changed everything I thought I knew about where silver goes from here. Let me tell you what I found. JPMorgan just took delivery of 2.1 million ounces of physical silver. Not paper, not promises, not futures contracts they're going to roll into next month. Physical silver bars. Metal that now sits in their vault with their name on it. 2.1 million ounces. One bank, one move. I want you to read that again because I don't think you processed it. JPMorgan, the most powerful bank in America, arguably the most powerful financial institution on earth, just said to the market, I don't want your paper, I don't want your IOU. Give me the physical metal. And they didn't take a little bit. They took 2.1 million ounces. That's more than 65 metric tons of silver moving into JP Morgan's possession in a single delivery window. Now let me add the second piece. COMEX registered silver, the silver that's actually available for delivery, just dropped to 85 million ounces. And it's falling fast. 2 weeks ago, it was above 102 million. Now it's 85. That's 17 million ounces gone in 14 days. Do the math with me. 17 million divided by 14 days. That's 1.2 million ounces per day draining out of the system. At that rate, the entire registered silver inventory hits zero in 71 days. Now, I'm not saying it will actually hit zero. The market will break long before that happens. Prices will adjust, something will give, but the trajectory is clear. The direction is undeniable. Silver is leaving the COMEX vaults faster than at any point I've tracked in my time covering this market. And here's the third piece that made me stop scrolling and sit up straight. March delivery starts tomorrow. Tomorrow. First notice day for March contracts is literally tomorrow. March is not like February. February was a smaller delivery month. March is massive. March is one of the biggest delivery months of the year, and it's hitting a vault system that's already bleeding over 1 million ounces per day. What do you think happens when major delivery demand crashes into a vault system with only 85 million ounces left? I'll tell you what I think happens. I think we're about to find out exactly how much physical silver actually exists, and I think the answer is going to shock a lot of people. Before I break down every single piece of data that brought me to this conclusion, I need to do something. I want to know where you're watching from and what time it is when you're watching this video. Drop a comment right now. Tell me your city or country and tell me the exact time on your clock. I want to see how global this audience really is. I want to know if you're watching at 3 a.m. in Tokyo or 7 p.m. in London or midnight in New York, because what's happening in silver right now is a global story. It's not just America, it's not just China, it's everywhere. The shortage is worldwide, the awakening is worldwide, and I want to see that reflected in the comments. So pause for 5 seconds, type your location and your time, and then keep watching. I'll be reading those comments personally. Now, if you're new here, welcome to Finance Currency. This is the channel where I cover silver and gold with real data, real numbers, no hype, no clickbait, just the raw information you need to make your own decisions in this market. I don't tell you what to buy. I don't give financial advice. What I do is show you the data that the mainstream financial media ignores, the vault numbers they never mention, the delivery statistics they don't understand, the Shanghai premiums they can't explain. If that sounds like something you need right now, hit subscribe, smash the like button, and hit the notification bell so you don't miss tomorrow's video, because tomorrow is first notice day and I'll be covering it live. Now let me show you why I believe $92 is not the top. Why I believe $92 is the last resistance before $100. And why I believe what happens tomorrow might accelerate this entire move. Silver's spot price right now is $92.14. That's up 4.7% from yesterday's close. This week alone, silver is up 9.2%. And since February 17th, silver has gained 26.3%. Let me put that in perspective. If you bought $10,000 worth of silver on February 17th, you're sitting on $12,130 today. That's $2,130 profit in less than 2 weeks. On silver. The metal they told you was boring. The metal they said would never move. The metal that's been suppressed for decades. 26.3% in 11 trading days. And it's not done. Here's what I need you to understand about the $92 level and why breaking it matters so much. $92 was the last major resistance level between here and $100. Look at the chart. After $92, there's nothing. The path to $100 is wide open. No historical resistance. No technical barriers. Just empty space waiting to be filled. Silver hasn't traded at $100 on the international spot market since never. Silver has never traded at a $100 spot. The all-time high was around $121 in January, but that was a spike that crashed almost as fast as it rose. This time is different. This time, the move isn't being driven by retail speculation. This time, the move is being driven by physical metal leaving the system. And that's a very different kind of rally. The January spike was fast money, hot money, speculative money that came in quick and left even quicker when margin requirements got raised. This move, this is institutional money. This is JPMorgan taking 2.1 million ounces. This is Goldman Sachs stopping contracts. This is BNP Paribas demanding physical delivery. This is the biggest banks in the world saying, we want the metal. And when the banks want the metal, you better believe something is happening. Let me take you inside the COMEX numbers because this is where the real story lives. And I promise you, by the end of this section, you're going to understand why I called this video what I called it. COMEX stands for Commodity Exchange. It's where the big players trade silver futures. A futures contract is basically a promise. It's a contract that says, I will deliver this much silver at this price on this date. Now, here's what most people don't understand about COMEX. The silver in the vaults is what backs those promises. It's the collateral. It's the proof that if someone stands for delivery, the metal actually exists to deliver. There are two categories of silver in COMEX vaults, eligible and registered. Eligible silver is silver that meets the purity and weight standards for delivery, but it's not available. The owner hasn't made it available. Think of it like money in a savings account that you haven't moved to checking. Registered silver is different. Registered silver is available for delivery right now. It's sitting there with a warrant attached, ready to go. This is the metal that actually backs the futures contracts. This is the silver that can actually be delivered when someone demands it. When I track COMEX, I track registered silver, because that's the real number. That's the number that tells you whether the system can actually deliver what it's promised. And that number just dropped to 85 million ounces. Let me show you the trajectory. January 15th, 118 million ounces registered. January 31st, 109 million ounces. February 9th, 102.3 million ounces. February 17th, 94 million ounces. Today, 85 million ounces. That's 33 million ounces gone in 30 days. 33 million ounces is approximately 3.9% of annual global mine supply, just gone, walked out of the COMEX vaults, taken by someone who wanted physical metal instead of paper promises. Now here's what really got under my skin when I was building this data tonight. 0 ounces coming in. I went through the daily vault reports, checked every single entry, looked for any deposits, any additions, any new metal coming into the system. Nothing. Not one single ounce of new silver has entered the COMEX registered category in the last 14 days. The door only opens one direction, out. Think about what that means. The world's most important silver trading venue is experiencing a one-way flow. Metal is leaving. No metal is arriving. The inventory is draining and nobody is refilling it. Why isn't anyone refilling it? That's the question that should keep you up at night. If silver was abundant, if supply was healthy, if there was plenty of metal sloshing around the system, someone would be depositing silver into COMEX. Miners would be delivering their production. Refiners would be adding supply. Someone would see the opportunity and move metal in. But they're not. They're not because they can't, or they don't want to. Either way, the result is the same. The vaults are draining and the drain is accelerating. Let me put 85 million ounces in perspective. The total open interest in COMEX silver futures is approximately 148,000 contracts. Each contract represents 5,000 ounces. That's 740 million ounces of paper claims on silver, 740 million ounces of promises, 85 million ounces of registered silver. That's a ratio of 8.7 to 1. For every ounce of deliverable silver in the COMEX vaults, there are 8.7 ounces of paper claims against it. Now, in normal times, this doesn't matter much. Most futures traders don't actually want the metal. They're speculating on price, they close their positions before delivery, they roll to the next month, the game continues. But we're not in normal times. We're in a time when JPMorgan is taking 2.1 million ounces. We're in a time when Goldman is demanding physical. We're in a time when the Shanghai premium is $15 over spot. We're in a time when registered silver is falling by 1 million ounces per day. The assumption that nobody actually wants delivery is breaking down. And when that assumption breaks down completely, the 8.7 to 1 ratio becomes a problem. A big problem. A problem that can only be solved by price going much, much higher. Here's the math that nobody in the mainstream media wants to talk about. If just 12% of open interest stands for delivery in March, that's 17,760 contracts. At 5,000 ounces per contract, that's 88.8 million ounces. 88.8 million ounces demanded, 85 million ounces available. That's a 3.8 million ounce shortfall. And that assumes no further drain between now and then. That assumes registered silver stays flat at 85 million. It won't stay flat. It's been falling over 1 million ounces per day. By the time March deliveries are complete, registered could be below 70 million. Do you see where this is going? The math doesn't work. And when the math doesn't work, something has to give. Either delivery demand collapses, which means people don't actually want the metal, or price explodes to a level that brings new supply into the system. I know which outcome I'm betting on, because when I look at the delivery data, demand is not collapsing. Demand is increasing. The people who want silver are not backing down. They're doubling down. Which brings me to tomorrow. March 1st notice day. Tomorrow is when everyone holding a March futures contract has to make a decision. Do they roll the contract to May and kick the can down the road? Or do they stand for delivery and say, give me my silver? Based on what I'm seeing in the open interest data, a significant number of contracts are not rolling. They're standing. And when they stand, they're going to be demanding silver from a vault that only has 85 million ounces left. Now let me talk about the number that made me stop everything I was doing and record this video. JPMorgan, 2.1 million ounces. Let me break down exactly what happened, because the implications are massive. On the most recent delivery day, COMEX issued 2,847 delivery notices. Each notice represents one contract. Each contract is 5,000 ounces. That's 14.2 million ounces changing hands. Now here's where it gets interesting. When you look at who's delivering and who's receiving, you can see exactly which banks are on which side of the trade. JP Morgan stopped 421 contracts. Stopped in COMEX language means they received delivery. They took the metal. 421 contracts times 5,000 ounces equals 205,000 ounces. 2.1 million ounces. One bank, one delivery window. Let that sit for a second. This is not a retail investor buying a few hundred ounces of silver eagles. This is JP Morgan, the largest bank in America, one of the most systemically important financial institutions on the planet, taking possession of 2.1 million ounces of physical silver. At current prices, that's approximately $193 million worth of silver in one move. Why? Why would JP Morgan want $193 million of physical silver sitting in their vault? There are only a few possible answers. Answer 1, client orders. Someone is paying JP Morgan to acquire and hold physical silver on their behalf. A hedge fund, a sovereign wealth fund, a ultra-high net worth family office. Someone with deep pockets who wants exposure to physical metal, not paper. Answer 2, proprietary positioning. JP Morgan themselves, for their own book, wants to own physical silver. They see something coming. They want the metal in their vault when it happens. Answer 3, hedging. JP Morgan has some other position, maybe a short position in the options market, maybe a structured product they sold to clients, and they need physical metal to hedge that exposure. All three of these answers point in the same direction. Someone with deep knowledge of this market believes physical silver is worth holding right now. JP Morgan is not a dumb money player. They have more information than almost anyone. They have analysts, they have traders, they have relationships with every major mining company and refiner on earth. They see flows that you and I will never see, and they just took 2.1 million ounces. Read that again. Now let me show you who else was on the receiving end. Goldman Sachs stopped 187 contracts. That's 935,000 ounces. Almost a million ounces going to Goldman. HSBC stopped 134 contracts, 670,000 ounces. BNP Paribas stopped 312 contracts, 1.56 million ounces. That's the largest French bank saying, give me the metal. Morgan Stanley stopped 89 contracts, 445,000 ounces. Deutsche Bank stopped 67 contracts, 335,000 ounces. Added up, JP Morgan, 2.1 million ounces. BNP Paribas, 1.56 million ounces. Goldman Sachs, 935,000 ounces. HSBC, 670,000 ounces. Morgan Stanley, 445,000 ounces. Deutsche Bank, 335,000 ounces. That's over 6 million ounces taken by just 6 banks in one delivery cycle. 6 million ounces is 7% of the entire registered inventory. Gone in one move, taken by the biggest names in global finance. These are not names you associate with wild speculation. These are not names you associate with retail hype or Reddit pumps or YouTube influencers. These are the names that move markets. And every single one of them said the same thing. I don't want your paper. I don't want your promise. Give me the physical silver. There's a phrase I keep coming back to when I see data like this. They know something we don't. I can't tell you exactly what they know. I don't have a source inside JP Morgan's trading desk. I don't have a mole at Goldman Sachs leaking me information. But I can see what they're doing. And what they're doing is accumulating physical silver at a pace I have never seen in my time tracking this market. Let me give you some historical context. In January 2024, total COMEX silver deliveries for the entire month were 12.4 million ounces. That was considered a high month. We're not even through February yet, and we've already seen 28.6 million ounces delivered, more than double January's total. March is projected to be even bigger. The delivery demand is not slowing down. It's accelerating. And it's not retail driving this. It's institutions. It's the big banks. It's the players who actually have the capital and the connections to take physical delivery at scale. Here's what that tells me. The smart money is moving. The smart money sees the same vault numbers I'm showing you. They see registered silver at 85 million and falling. They see the Shanghai premium at 5 times and growing. They see the supply deficit in its 4th consecutive year. They see the industrial demand from solar panels and EVs and AI data centers. And they're acting, not talking, not posting on social media, not appearing on CNBC, acting, taking metal, building positions. While everyone else is sleeping, the banks are quietly accumulating physical silver. By the time the general public wakes up to what's happening, I believe it will be too late to buy silver anywhere near current prices. The institutions will have taken everything available at $92, and the next available silver will be at $100 or $110 or higher. That's how these moves work. They happen slowly, then all at once. We're in the slow phase right now, the accumulation phase, the phase where smart money is positioning while dumb money is distracted. But the all-at-once phase is coming, and I believe it might start tomorrow. Now let me take you to the other side of the world, because what's happening in Shanghai confirms everything I just showed you about COMEX. Shanghai silver is trading at 107.40 yuan per ounce. Let me say that again because I don't think it registered. 107.40 yuans, not 92s, not 95, 107. The Shanghai Gold Exchange, which is where physical silver trades in China, is pricing silver $15 higher than the international spot price you see when you type silver price into Google. That's a $15 premium. A 16.7% premium on the same metal. In a normal, functioning, efficient market, that gap would be arbitraged away in about 15 minutes. Here's how arbitrage works. You see silver trading at $90 in New York and $107 in Shanghai. You buy in New York, ship to Shanghai, sell at $107. You just made $50 per ounce minus shipping costs. Easy money. Traders do this all day, every day, in every commodity market in the world. It's called arbitrage. It's why prices stay roughly the same everywhere. If they get out of line, someone immediately profits from closing the gap. But the gap isn't closing. The Shanghai premium has been above $10 for weeks now, and it's growing, not shrinking. Why isn't anyone arbitraging this? There are only 2 possible explanations. Explanation 1, there isn't enough silver to buy in New York and ship to Shanghai. The metal physically doesn't exist in sufficient quantities to close the gap. Explanation 2, there are barriers preventing the metal from moving. Export restrictions, shipping constraints, geopolitical factors. Something is blocking the flow. Either explanation is incredibly bullish for silver. If there isn't enough metal, that's a physical shortage, and physical shortages don't resolve until price rises high enough to destroy demand or incentivize new supply. If there are barriers to movement, that's a fracturing of the global silver market. East and West are pricing silver differently because they're effectively operating as separate markets. And when markets fracture, the price discovery shifts to whoever has the physical metal. Right now, that's Shanghai. China is the world's largest consumer of silver. Industrial demand for solar panels alone is over 180 million ounces per year. Add in electronics, EVs, 5G infrastructure, and China's silver appetite is insatiable. And China is willing to pay $107 for silver while the rest of the world is still pricing it at $92. Let me tell you what that means for the international spot price. Gaps like this close by the lower price rising to meet the higher price, not the other way around. Think about it. Shanghai isn't going to suddenly drop from $107 to $92. Chinese buyers aren't going to say, actually, we were paying too much, let's pay less. No. Chinese buyers need silver for their factories, their solar installations, their industrial base. They'll pay whatever it takes. What's going to happen is the international price is going to rise to meet Shanghai. $92 is going to become $97, then $102, then $107, then probably higher. The Shanghai price is not the anomaly. The Shanghai price is the signal. It's telling you what physical silver is actually worth to people who actually need it. And right now, that price is $107. Now, here's something that most channels aren't covering today that I think is critically important. It's not just silver that's moving. Palladium closed up 5.1% today at $2,141 per ounce. Platinum closed up 6.8% today at $2,797 per ounce. 6.8% for platinum in one day. That's an absolutely massive move. Platinum typically moves maybe 0.5% on a normal day. 6.8% is a 14-fold increase in volatility. Something is happening across the entire industrial precious metals complex. Now, here's what most people miss about this pattern. Gold was flat, basically unchanged at $5,994. If this rally was about the dollar weakening, gold would be leading. Gold is the most dollar-sensitive precious metal. If this rally was about interest rate fears, gold would be leading. Gold is the safe haven of choice when people are worried about monetary policy. But gold is flat. Gold is sitting still. Silver is up 4.7%. Platinum is up 6.8%. Palladium is up 5.1%. Gold is flat. What does that tell you? It tells you this rally is not about macroeconomics. It's not about the dollar. It's not about interest rates. It's not about monetary fear. This rally is about physical shortage. Silver, platinum, and palladium all have significant industrial demand. They're used in manufacturing, they're used in catalytic converters, solar panels, electronics, medical devices, EVs, real physical demand for real physical applications. Gold is primarily monetary. People buy gold as a store of value, not because they need it for their factory. When industrial metals surge and monetary metals sit flat, that's the market screaming that there's a physical supply problem. Manufacturers need metal. They can't get enough. They're bidding up prices, trying to secure supply. And it's happening across multiple metals simultaneously. This is the most dangerous type of rally for anyone short these metals. Because it's not about sentiment. It's not about technicals. It's not about algorithms or speculation or hot money. It's about one simple question. Is there enough metal? And across silver, platinum, and palladium, the answer right now is no. There isn't enough metal. And when there isn't enough metal, there's only one way to balance the market. Price goes up, way up, until either demand is destroyed or new supply comes online. Destroying demand in industrial metals is hard. Tesla still needs silver for their cars. Solar companies still need silver for their panels. Chip makers still need silver for their semiconductors. This demand is structural. It's not going away because silver is $100 instead of 92s. New supply coming online takes years. You can't open a silver mine overnight. You can't fast-track permitting and construction and development. The supply response to higher prices is measured in years, not months. So what happens in the meantime? Price keeps rising until something gives. And based on the data I'm seeing, nothing is about to give anytime soon. Let me now put every single piece of this together, because I didn't spend 4 hours researching tonight to give you a maybe. I want to tell you exactly what I think happens next. Here's the complete picture. Silver is at $92. It just broke through the last major resistance level. The technical path to $100 is wide open. Registered silver in COMEX vaults has collapsed from 102 million ounces to 85 million ounces in just 2 weeks. That's 1.2 million ounces per day draining out of the system. No new silver is entering the vaults. The door only opens outward. Nobody is restocking. Nobody is adding supply. JpMorgan just took delivery of 2.1 million ounces. Goldman, HSBC, BNP Paribas, Morgan Stanley, Deutsche Bank all took significant physical deliveries. The biggest banks in the world are accumulating metal. Shanghai is trading at $107. That's a $15 premium over spot, a premium that should be arbitraged away but isn't, because either there's no silver to ship or there are barriers preventing movement. Industrial metals are surging together, silver, platinum, palladium all up massively while gold sits flat. That's the signature of a physical shortage, not a monetary rally. March 1st notice day is tomorrow. March is a major delivery month, and it's hitting a vault system that's already critical. The 50-day moving average has been climbing for 9 consecutive months without a single down tick. Every dip has been bought. Every pullback has been temporary. The trend is bulletproof. I cannot find a bearish data point. I spent 2 hours going through every number trying to build the bear case. I wanted to find the weakness. I wanted to stress test my thesis. And I couldn't do it. Every single indicator points the same direction. Up. Here is my prediction. Silver breaks $95 this week. Not, maybe, not hopefully, I believe it happens. Silver reaches $100 within the next 21 trading days, before the end of March. The combination of March delivery demand, vault drainage, Shanghai premiums, and institutional buying creates enough pressure to push silver to triple digits. Silver reaches $120 by the fourth quarter of 2025. That's not hype. That's following the math of a market where demand exceeds supply and the gap widens every month. And if something breaks, if there's a delivery failure, if COMEX can't meet obligations, if the market truly seizes up, the upside is much higher than $120. I want to share something personal here because I think it matters. When silver spiked to $121 in January and then crashed to $77.7, I got messages from people panicking. People who bought at $110 asking if they made a terrible mistake. People who bought at $95 asking if they should sell at $80 and cut their losses. I told every single one of them the same thing. Zoom out. Look at the data. The physical shortage didn't disappear because the price dropped. The vault numbers didn't suddenly reverse. The Shanghai premium didn't vanish. The January crash was caused by margin hikes and paper selling. It was caused by COMEX raising collateral requirements and forcing leveraged traders to liquidate. It was not caused by silver suddenly becoming abundant. And here we are, less than 6 weeks later, with silver back at $92 and climbing. Every single person who held through that crash is now watching their position recover. The people who listened to the data instead of the fear are being rewarded. And the people who panic sold at $80, they're kicking themselves right now. I'm sharing this because $100 is going to create the same fear. Silver will hit $100 and there will be a pullback. Maybe 10%, maybe 15%. And people will flood the comments saying, see, I told you the rally was over. $100 was the top. Sell everything. And I'm going to be right here, showing you the data, telling you to look at the fundamentals. Registered silver falling. Shanghai above $105, banks taking physical, no new supply entering the system. The data doesn't know about round number resistance at $100. The data knows there isn't enough silver, period. Now let me give you the risks because I think it's irresponsible not to. Risk 1, margin hikes. COMEX can raise margin requirements at any time. When they do, leveraged traders are forced to sell. We saw a 35% crash in January because of this. It could happen again. If it does, silver might drop from $92 to $78 or even lower. It would feel terrible. But every single pullback in this rally has been bought aggressively. The crashes don't last. The trend does. Risk 2, delivery demand collapses. Maybe everyone rolling their contracts instead of standing for delivery. Maybe March is quiet and the vault drainage slows. Possible, but the data doesn't support it. Open interest remains elevated. The people who want silver are not backing down. Risk 3, I'm wrong. $92 holds. Silver pulls back to 85. Markets don't move in straight lines. If that happens, I'll tell you honestly. I'll show you the updated data and adjust my view. I don't marry my predictions. I follow the data. But right now, tonight, staring at every number I can find, the data is unanimous. Silver goes higher. Before I let you go, I want to remind you about the question I asked at the beginning. What time is it and where are you watching from? Drop that in the comments right now. I want to see how global this community really is. I want to see comments from Tokyo and London and Sydney and Sao Paulo and Mumbai and Dubai. Because what's happening in silver is not an American story. It's a global awakening. And while you're in the comments, tell me your prediction. Does silver break $95 this week? Does it reach $100 in March? Does it hit $120 by end of year? I'll pin the best predictions and we'll see who's right. Share this video with anyone who owns silver or is thinking about buying. Because tomorrow when March 1st notice day hits and the next wave of delivery demand crashes into a vault system with only 85 million ounces left, you're going to want to have seen this data first. Go watch my last two videos. The first covers the Shanghai explosion in complete detail. The second covers the institutional accumulation pattern I've been tracking for months. Links in the description and in the pinned comment. Those three videos together give you the complete picture. This is Finance Currency. Stay sharp, stay stacking, and I'll see you tomorrow with the March 1st notice day numbers.